What's up, you guys? It's Graham here. So I'm going to be honest, this is one of the craziest markets that I've ever seen. Normally, I tend not to be too outspoken about my own thoughts since I'd like to think the data speaks for itself, but never have I witnessed such a quick stock market reversal to the point where investors have completely flipped from stock market collapse to stock market bubble in just 90 days. And if you think things are getting out of hand, turns out this is just the very beginning. That's right, despite the entire market surging to brand new record highs, beneath the surface, the US dollar is quietly headed towards its biggest decline since 1986. International stocks have now begun outperforming the United States for the first time in decades, and starting on August 1st, all bets are back on the table for brand new tariffs. That's why we really got to discuss exactly what's happening, why the Federal Reserve just decided not to lower interest rates, if this is something to be concerned about, and then how you could best protect your money starting today, because like it or not, we're in for a wild ride. Although before we start, if you appreciate the last minute breaking news update videos like this, it would mean the world to me if you hit the like button or subscribe if you haven't done that already. I know it's silly to ask for it, I don't like it myself, but it does help out tremendously, and as a thank you for doing that, here's a picture of a frog. So thanks so much, and also big thank you to Gemini for sponsoring this video, but more on that later. Alright, now before we break down what's happening in the markets and what Jerome Powell just said about his rumored resignation, we first need to talk about Trump's #1 priority, and that would be lowering interest rates. Look, it's no surprise, over the last year, there's been a major push to cut interest rates as fast as possible to help boost the economy, and in the process of doing so, there have been some choice words thrown at Jerome Powell for keeping rates higher than expected, including but not limited to stupid, terrible, numbskull, dumb, fool, mule, major loser, low IQ, not a smart person, and too late. But despite the political pressure, accusations, and potential lawsuits, Jerome Powell is staying true to his objective, which is to keep interest rates high enough not to trigger another round of inflation. However, here's the part that almost no one saw coming. So far, we have seen almost no inflation whatsoever from tariffs. Like, according to CNN, consumer prices rose just 2.4% last month. That was less than economists had expected and only slightly higher than the 2.3% rate in April, which was the US economy's lowest inflation since February of 2021. Even Jerome Powell admitted that just a few items are growing in price as a result of tariffs. Although in terms of why this is happening, he offers just one single explanation. That is, stores are still working through the inventory that came into their warehouse before Trump put tariffs in place. Meaning, yes, prices will go up eventually, just not right now, according to Powell. Although in terms of what happens next, the reason Trump is no longer looking to fire Jerome Powell and why people have started to believe that we're forming a new stock market bubble, there's one more topic that most people completely miss that partially explains why asset prices are skyrocketing in value, and that would be the declining US dollar. Look, not to be an alarmist here, but if you're not aware, the value of the US dollar has had its worst start to the year since 1973, meaning each and every day, more money is created, more debt is accumulated, and the higher every other asset balloons. Like, think of it this way. Back in the early 1970s, the value of the dollar was pegged to that of gold, which was set at a fixed price of $35 an ounce. At that time, minimum wage brought in $52 a week, which equated to nearly 1.5 ounces of gold. Well, today that minimum wage would have to increase to more than $4,800 a week just to match. You get where I'm going with this. The value of our dollars lost a significant amount of its purchasing power, while the price of gold is now trading above $3,300 an ounce. And even though the US dollar is still the reserve currency of the world, it's not stopping it from constantly getting devalued. So why is this happening? Well, first we have money printing. In this case, our national debt just recently surpassed $37 trillion. It's on pace to top $56 trillion in just another 10 years. And now we're at the point where there's just no turning back. The only viable option is to either print a lot more money or cross our fingers that inflation bails us out and makes today's $37 trillion feel like tomorrow's spare change. The second, there's also political instability. The fact is, fewer countries are buying US debt because they're concerned about the long-term value of the US dollar, partly because of growing government debt, but also because of tariffs. In fact, according to a recent survey, 70% of investors said that they no longer want to invest in the dollar due to growing geopolitical risks, up from 31% a year ago. All of this is leading to some very interesting predictions as to what could happen next, with one of those being Bitcoin. In this case, the billionaire Tim Draper made the argument that Bitcoin is becoming a global safe haven as people start escaping flawed systems, with global adoption accelerating due to rising economic fear. He's also gone so far to say that software-based money is a better technology than government-issued currency and predicted a tipping point starting as early as 2035. This is evidenced by the fact that recently 65% of investors say that they plan to buy or invest in digital assets in the future, which is a huge increase from the just 16% that currently own it. Like, this has now become so impossible to ignore that half of financial advisors plan on recommending cryptocurrency investments to their clients within the next 12 months. Of course, critics of this argue that just because something has gone up a lot in the past doesn't mean that will continue. Bitcoin is not immune to drops in the market, and it could lose a significant amount of value. And long term, the dollar is still backed by the full faith and force of the US government. But you also have to admit, falling interest rates impact the value of the dollar by making it less attractive to foreign investors. So with interest rates eventually positioned to be reduced over the next few years, it's more important than ever to understand exactly what's going to happen, the impact this is about to have on stock and home values, and then what you could do with your money starting today to give yourself the best chance possible of coming out ahead profitable. Although before we go into that and what Jerome Powell just said as of a few hours ago, when it comes to cryptocurrency, here's what I found very interesting. Believe it or not, a recent study found that Gen Z is 4 times more likely to have crypto than a 401k. And that's not exactly surprising, given how the dollar has already fallen to its lowest level since 1973. All of this points to the fact that cryptocurrencies are gaining momentum, mainstream adoption is beginning to grow, and one of the best ways to capitalize on this is with our sponsor, the Gemini credit card. For those unaware, they are the only instant crypto reward credit card that gives you Bitcoin back every time you purchase. For example, you could get up to 4% back on transportation, 3% back on dining, 2% on groceries, and 1% back on everything else, which is incredible for a card with no annual fee. On top of that, they also allow you to pick from more than 50 other cryptocurrencies that you could switch to at any time. From my perspective, this is just an easy way to get rewards that aren't constantly going unused or getting devalued. And overall, Bitcoin rewards earned and held for 1 year on the Gemini credit card have actually appreciated 176% on average. This just makes it easy to gain a little exposure to Bitcoin without actually having to go and buy it yourself or try to time the market. Not to mention, this World Elite MasterCard comes in 4 stainless steel colors. You could get black, silver, rose gold, or Bitcoin orange. You could also check the description for more information on rates and fees and see if you're eligible with no impact to your credit score. So if you would like to earn Bitcoin or select from more than 50 different options, sign up today at gemini.com/Graham to start earning instantly. And as a special bonus, you could get $200 of Bitcoin when you spend $3,000 in the first 90 days. Again, to sign up today, just go to gemini.com/Graham or use the link down below in the description. Thank you so much, and now let's get back to the video. All right, now before we talk about what Jerome Powell just said as of a few hours ago and my own investing plan throughout the rest of the year, there is another topic that is impossible to ignore, and that would be the stock market. Here's the thing, objectively, stocks have done extremely well this year. Like, despite the dip, the S&P 500 is already up over 7%. We've consistently hit brand new all-time highs. And people are now believing that we're in a brand new stock market bubble. So what's going on? Well, from a technical standpoint, one analysis warns that the NASDAQ has gone 60 trading days without closing below its 20-day moving average, which is the second longest streak in history. The longest occurred in 1999, right before the dot-com crash. The S&P 500 is also currently trading at 26 times forward earnings, significantly above its historic average of 18. So is this something to be concerned about, especially now that meme stocks are trending again? Well, even though some strategists believe that AI mania is worse than the 1990s tech bubble and that the S&P 500 is growing increasingly concentrated within the top 10 companies, keep in mind that back in 1999, the tech giant Cisco traded at more than 200 times earnings, whereas today our largest company, Nvidia, is trading at only 40 times earnings, suggesting that things were not as bad as they once were, but it's something to keep in mind, just in case. Now, on top of that, even though there could be cause for concern, a separate analysis found that a few companies leading the way in the S&P 500 could actually be good for future profits. Why? Well, since 1950, it was found that a rising concentration led to even higher returns, especially since those were the companies generating the most revenue. However, in terms of what will actually happen over these next 12 months, it's really anyone's guess. For instance, BlackRock noted that there are several $1 trillion worth of cash sitting on the sidelines, patiently invested in short-term treasuries that have yet to be deployed. And this new wave of meme stock investing is simply fun money that investors don't have any other use for. This is partly why Morgan Stanley Stanley reset their price target of the S&P 500 to 7,000 in 2026. Goldman Sachs sees 6,600 in range, and several others anticipate the chance of the S&P 500 reaching higher than 7,000 as tariff concerns begin to alleviate. Plus, historical data shows that all-time highs are really nothing to be feared. Instead, they're a natural part of investing that tends to lead to even more all-time highs in the future. Although even though all of this sounds great, here's how this is about to impact other markets, and this is where things get very interesting. Housing prices. As of now, there's finally some good news for buyers. Even with mortgage rates currently hovering above 6%, which is the highest level that we've seen in decades, home prices have actually started to flatline throughout 2025. In fact, according to CoreLogic, national home prices are up just 1 to 2% compared to last year, which when you adjust for inflation is basically a mild decline. Although just keep in mind that not every housing market is experiencing a slowdown in the same way. For example, cities like Cleveland, Louisville, and Hartford are seeing year-over-year price gains of about 4%, all due to steady demand thanks to relative affordability. While on the flip side, areas like Austin, Tampa, Miami, and Dallas have fallen anywhere from 3 to 6%, with inventory piling up after the pandemic-era boom. Even Cape Coral is now priced below the national median after being one of the hottest markets for the last 2 years. But like I said, nationwide sales volume is declining, with Redfin reporting that we're on track for 4.1 million home sales this year, which is one of the slowest in a decade. On top of that, more inventory is also beginning to climb, with Zillow noting a 17% increase from a year ago. As a result of that, those homes are sitting on the market for longer, taking an average of 19 days to go pending versus just 11 during the peak of 2023. Now, in terms of what this means for the rest of the year and throughout 2026, Zillow predicts average home values will actually fall by 2% throughout these next 6 months, basically giving back a small portion of last year's increase. But CoreLogic believes that home prices will continue to go higher due to excess demand, with a 4% increase over these next 12 months. Although in fairness, this increase might also just be keeping pace with inflation, and these predictions so far have not entirely been accurate in the past. But you know what, hey, it's something. Now overall, in terms of my take, as someone who's been professionally involved in real estate since 2008, here's what I've noticed. You have a lot of sellers right now that are testing the markets with unrealistic asking prices and holding out for bidding wars, which just isn't happening. You also have a lot of sellers placing their home on the market at a price where, if it sells, great. But if not, they don't mind holding on to it because they've got a 2.8% mortgage and their cost every month is pretty low. That means if you're in the market for a home, now is the first time in years that you could actually negotiate and you aren't up against a dozen other buyers. Price cuts are happening throughout nearly a quarter of all listings, and almost 1 in 7 are falling out of escrow. So take advantage of it and be patient to find a deal that's worth buying. Although in terms of what this means for you, when interest rates might eventually come back down, and what Jerome Powell just said, here's what you came for. Like I mentioned earlier, as of a few hours ago, the Federal Reserve once again decided to postpone rate cuts, at least for another few months until their September meeting. After all, they have concerns about escalating tariffs, rising costs, eventually getting pushed back onto the consumer, and a strong labor market that is keeping prices high. So in their mind, there's no reason to cut rates unless it's absolutely needed to keep the economy afloat. But in terms of when we might finally see that first rate cut, as of today, the market is pricing in a higher likelihood of this beginning to happen on September 17th. Although I do want to preface this by saying that the market has been predicting this for quite some time, and so far it's not really come true, so that's something just to keep in mind. That's why, just from what I've noticed, if we're going to see a rate cut, it's not exactly going to be a surprise out of nowhere. Generally, the Federal Reserve likes to signal their intentions to the market ahead of their meeting. That way, the market has a chance to react, and people tend to price in this information before it actually happens. So just expect that when we're about to see a rate cut, the market should know, for the most part, about a week or so in advance. Now, in terms of my own thoughts, I gotta say I do get a little concerned when meme stocks and altcoins start pumping out of nowhere. To me, it's a signal that maybe people are getting a little ahead of themselves and a pullback is in order. But I also think that everything is looking rather optimistic for more trade deals throughout the rest of the year. And eventually, we'll also get those elusive rate cuts after May of 2026, when Trump appoints somebody else to the head of the Federal Reserve. Of course, whether or not this is already priced into the market is yet to be seen. But one thing is certain. Over the last more than 8 years that I've been posting videos on YouTube, my advice has always been relatively consistent. I personally just dollar cost average into the markets on a regular basis throughout broad index funds, regardless of the price, and studies show that this yields the best result. I don't believe in trying to time the market, perfectly sell the peak, and buy the bottom. Really any day, it's a heads or tails if the market's going to be up or down. Sure, sometimes you might get it right for an extended period of time, but long term, it's rather unnecessary, and you usually end up losing more than you gain. That's why it's so important to just ignore the noise, make a plan, stick with it no matter what, and always don't forget to hit the like button and subscribe if you haven't done that already. So with that said, thank you so much for watching, and if you made it to this part of the video, feel free to leave a comment. I do my best to read and reply to as many of you as I can, and I'll do my best to give you a response. So thanks so much, and until next time.